Hi, and welcome to this edition of the Insurance Experts. It's my pleasure to have on the line Colin Wood. Colin is a long-term care specialist, and this is actually our second interview together. Thanks for joining us again, Colin.
Mark, you're welcome, as always.
So I know we covered this a little bit last time, but share with us again, how you got into the long-term care space.
Well, I was a contractor and inventor, so we invented tennis court surfaces and installed them all over the world. In fact, a whole World Championship tennis tour existed because of a surface my dad cooked up out of his imagination. He was a player. And we were going to change the world of tennis, have it soft surfaces, a boon to plus 40 souls and sinews. The first product was called Supreme Court. You be the judge. Anyway, ultimately, my dad got, well, it turned out he had dementia. I just thought he was sleepy. Yeah. And he died finally of Alzheimer's, but business slides right out the window with dementia. Forget it. You can't have it. So then a friend of mine's father knew I was looking for work and advised me on long-term care. You got to try it. You got to try it. And I did. And initially it was, I saw 15 people a week on average for years. And I got an education. I met people whose spouse was right there in the adjoining room with caregivers, people who were already beyond repair, so to say. And I've learned a lot.
So how long have you been in the long-term care insurance space?
20 years.
Okay. Very cool. Well, you mentioned business owner, and I know this is important to your family, and you told me about a story about a business owner client that you were working with. Can you tell us a little bit about the backstory there and how you came about them?
Yes, I've forgotten how I actually met them, but we got along right away. I mean, they're sort of the typical story for everybody is my parent. It's a story about a parent, and that becomes their future portrait. And it is often really dismaying and disturbing. And they wanted to protect their business, which they co-own, their children, and from should something happen to them. And they understood also, because they were young when I met them, they still are young, that it could happen anytime. And what would that mean? The advantage they had was the deductibility. They have a C corporation, and they are co-owners. So as executives, they have the ability. They can deduct their premiums. Take a deduction through the C corp.
Yeah. So how does that work exactly? What type of long-term care insurance solution design did you use for that?
Well, now known as the standalone, so-called traditional long-term care, which doesn't have a life component, which isn't deductible. And in essence, that's a policy that in their case had a growth component to it, compound interest on the benefits, and was also a 10-pay, which meant that from the time I met them in 2012 until 2022, they'll be paid up.
Okay, so they are almost done with paying their policy now.
Almost done.
Cool.
And every year it's kind of fun because we sort of I don't know if it's a tradition now, but since we met, every year it's, Colin, either we didn't get the bill or we lost the bill in the office somewhere, or when are we going to get the bill? And then it's kind of like, hey, how are you? And we review the policy, and every year they get to see that it's gotten larger and larger and larger. And then she said, how much longer again? I say, well, 2022.
So how much is the tax deduction worth for him approximately? What would you guess?
Well, that's a good. I don't know, but I'm guessing I would say probably 30%, maybe 35%, depending.
Okay. Wow. So they can take the deduction each year, and maybe it's several $1,000s off of their tax bill? Okay. Well, that's pretty cool. So you get to buy your long-term care policy, get a growing benefit, and get to take maybe 30% off the cost because of the tax savings.
You got it.
That's awesome. What happens when they get their benefits? Do they have to pay back the deduction, or how does that work?
Isn't that interesting? It's tax-free.
So it's both sides. You got to take it on the front end, and then obviously you get the
And the
benefits.
benefits are tax-free.
Oh, that's cool.
Right. So you know all the Mark,
Yeah.
you know you're a genius. You know all this stuff, but it's all tax qualified. So all the benefits from long-term care are they're tax qualified.
That's so cool. So if they're a C corporation, does it work differently if you're a smaller
of course
business?
not, because they are the recipients of any future benefits.
Okay.
Right.
What about like on the tax deduction side? Is there a limitation on what they can deduct if they're a small business versus a C corporation or anything like that?
That's a good question, Mark. I'm going to turn to you on that. What do you think?
I think there is, but
I know you do.
I'm wondering if you work with clients that have like an S corporation. Is it still valuable for them to take this deduction?
That there is always yes, because there is some deductibility nonetheless on their tax return. For long-term care, as you know. Right.
Well, way to put me on the spot like that. No,
because Mark, you're a very bright fella, and I know you know the answers to these questions.
Yeah.
But yes, of course, it's with any sort of corporation gives you leverage, tax leverage, and if you have a good CPA or someone who prepares your taxes, holy smokes!
Right. So I think that the moral to the story is if you or your spouse own a business, you should be looking at using your business to pay for the premium because you get this tax deduction that you don't have to pay back.
Of course.
Yeah. Cool. Well, thanks.
Where there's no business, if you can, if you have an HSA, that's also helpful.
Right. Yeah. There's a lot of different ways to pay for it. Right.
Yeah.
Okay, well, we'll definitely interview on a future episode. Maybe we'll talk HSAs, but thanks for joining me today on this edition of The Insurance Expert.